Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. And we're back, and today is midterm election day, and the outcome may have an impact on the stock market. So today I want to go over 3 key stats that give us a little bit of history and context about what happens on the Hill or in elections and how that can impact the stock market and what you might want to know going forward with your investments. I will give you a little bit of a spoiler warning. Number 1, we kind of covered this last week, and that stat still holds true, but it might be even better. And in almost any scenario here, I think you're going to be happy. I think the stock market is going to rise. So I'll go ahead and go over these stats and then give you a few of my thoughts and opinions. Now, this is all from a USA Today article. I will make sure that that link is in the bio below or in the description below right under this video. All right. So first, since 1950, the average return for the S&P 500 in the 12 months after the midterm, the S&P 500 has an average gain of 15%. That's good. Okay, that means from November 2022 all the way to November 2023, I would expect somewhere around 15%. Now, that is not a guarantee. This is history, okay? And it is an average. That is not a rule here. But again, if you see 15% or anywhere close to it between now and 2023, history says that works, right? And the other thing, too, is here's the caveat that we talked about last week. Last week, we had talked about the stat that the market tends to gain about 7.5% from November to April, which is 6 months, in any given year. So there you go. I guess in a midterm election year, you get double. And again, I'll take that. I think we would all enjoy an extra 15% in our portfolio. So we'll see if that happens. But again, that's the average return since 1950 in a midterm election year, or to be correct, 12 months after the midterm. So November to November. All right, the other thing here. In 17 of the 19 midterms we've had since 1946, the preceding 6 months, or the 6 months after the midterm, tends to be better than the 6 months before the midterm. Again, this is almost the exact same stat of November through April. This tends to be better. But in either case, in midterm election years, 17 of the 19 times that it has occurred, the market tends to perform better in that latter half, that part of those 6 months, November through April, in midterm election years. There have only been 2 times since 1946 that it did worse. Okay, so I'll take that. If I'm not mistaken, the stock market was down at least 19 to 20% at the end of October, even though October was great for us in terms of returns. But overall, that first 6 months, really that first half, we're talking May through October or so, that wasn't great. I think we all remember that. Let's get our minds and continue onward. But in the case, November through April, that's 2 stats that helps us to say, hey, things might be on the come up. Okay. All right. The next one here is if the outcome is as expected, with a Democratic president in either a divided Congress or a Republican sweep of both chambers. That means Republicans take the Senate and the House. If that happens, or if it's split, one party has one house, one party has one house, and one party has the other, meaning Senate or the House, then equity investors should, quote unquote, benefit, which is what it has here, and the average return in that scenario is 13%. So in either case, based on history, the market is about to be up, which I would hope to happen. But again, that is past information. They don't really predict future results. And the reason why I want to focus on that is because there are two things, just two, that could derail a part of this history and what we would hope to be a positive move in the stock market. Inflation. Inflation is still out there. We still have to fight inflation, and the Fed being the second one, because interest rates are still rising, and that is going to have an impact and has had an impact on the stock market as well. Thankfully, though, we've been through, 11 months of 2022, and the playbook is relatively clear. It wasn't necessarily clear in January, February, and it started to become clear a little bit in March, but you really want to shift your portfolio if you haven't already. Index funds still make sense here because regardless if you don't choose the right stocks or get into the right industry, if you have an index fund, history says, number one, you're going to be good across the board, right? We're talking decades. You're going to be in a great spot across the board because you're basically investing in everything. However, if you're looking to be a little bit more precise, you definitely want to pay attention, again, to what you're investing in and really get rid of the areas that have not been profitable. Any company, in my view, that is not profitable, taking out a lot of loans, those are the ones that have been falling the most. Okay, we can talk about Upstart that's that fell, I think 20% overnight. We've talked about several companies that have done that. Snapchat is down 80 and 90% on the year. Like, you definitely want to get out of those stocks unless you truly, truly, truly believe in those long term, which I don't think many people do, but I could be wrong there. You do want to focus on a lot of things that have worked already and can continue to work in a high interest rate environment. And those have been insurance. We talked about a lot about those. Healthcare. We talked a lot about those. And I've been focusing a lot on a lot of these car repair, mechanic type companies like O'Reilly's, like GPC, General Parts Company. And those have done incredibly well in this environment too. Those are a few places that if you're looking for individual stocks, you might want to pay attention there. Outside of that, index funds obviously make sense. And then again, that's really the next hurdle, right? Over the next 6 months, over the next year, even 2 years perhaps, inflation, interest rates are really going to dominate the market in my view, because that's really the last thing standing. Now, you can say that the recession is a part of that, because if you raise interest rates too quickly, you can press the entire stock market and the economy, or the economy rather, into a recession. That is a threat. However, there's so many different conflicting data points that say that yes, we're in a recession, or yes, we're going to be into one, deeply, and then other parts that say no, we're not going to be anywhere close to it. I can't call it. As someone who has a degree in economics, I still don't know, because you've got, positive news and negative news all at the same time. We also know that gross domestic product, the thing that tells us whether we're in a recession or not, was positive. We had 2 negative ones. By definition, that's a recession. And you had 1 positive one. And you're like, well, what do I do with that? The economy grew, which you want it to grow. You don't want to go into a recession. But if things are improving and the economy is expanding, then what do I do with that? And then what do I do with the fact that the labor market is at least slowing down, right? So how do we balance all these things? It's extremely difficult. So for me, I can't go forward with saying it's a recession or not. What I can do is say this: I know what works right now. Okay. And this is why I've been talking about insurance companies for a while. I'm not going to belabor that point. I've done entire videos about that, but we know what works. Continue investing in those areas. And I think it is obvious, extremely obvious, at least to those who subscribe to the channel and those who like and comment on videos like this. We know that it is blatantly obvious that if I'm looking at your balance sheet, it is negative, and it has been negative for several consecutive years, and you have to continue to borrow money. That's the first thing I'm getting rid of. Okay, that is not something that you want to continue investing in. So you probably want to be very careful about that and letting those types of companies go. What does this mean for crypto? Can't tell you. This is one of my beefs, quote unquote, with crypto, in that it's really difficult to analyze it. Not saying it's worthless. I'm not saying it's not a good investment. You call it what you want. What I'm saying is it makes it difficult, right? I can look and say that I think Progressive and T-Mobile are going to be good companies because of X, Y, and Z. And I can measure how many people are signing up. I can measure how many people are paying their premiums on time. And all that stuff makes sense to me, right? I can't, there's no consumer in Bitcoin. There's no balance sheet for Bitcoin. It just goes up or down, or any crypto, based on how people feel about it, which can be anything on any given day. Doesn't make it bad, it just makes it harder to evaluate. And that is what we're trying to do here. So that's why I stick more to the stock market than I do any other asset class. And again, those are the places that I think are going to continue to do well. Places where you have to spend money regardless of what is going on with interest rates, because we still don't know. And I think it makes sense to invest in things that are profitable and that bring in money, and it can do so on a consistent basis. If you can't do that, if you are a company that can't do that, or investing in something that I don't know what the answer is, that's a question mark that I don't want to have to answer, right? That's not something I want to bet my money on and put my money into if I can't say, look, I know for a fact this company is going to be here, right? I know for a fact this company is going to bring in more money, regardless of recession, regardless of interest rate hikes and all that kind of stuff. There ain't that many. Okay, there aren't that many companies that can say that, and that's why you see, if you look at a heat map of the S&P 500 and you say year to date, right, what has happened between January and now, it ain't but a few sections that light up green. Oil and gas, we've talked about that. That's one of them. You have a few consumer goods companies that pop up that, buy and sell food, which is what we actually have to have. Then you got healthcare, and you have a little speck of the auto industry for companies like GPC, and that's really it. You got M-Phase out there. Outside of that, there are not many, especially in the S&P 500. So you got to be very, very select over the next 6 months, in my view. All right, that is it for me. If you want to learn more about investing and what stocks actually make sense, I did do a video. We talked about it last week where I covered 10 companies that also pay a dividend that you do want to pay attention to. That is inside the members only. Also, for our members, you are going to get two videos this week. So if you have not joined the members only, this is your chance to do so you can become a better investor. All right, that is it for me. I'll talk to you later. Bye.